So Target was similar to Walmart in that both beat across the board for earnings, revenue, and comp sales. The comp sales pretty strong, up 3.4% for Target, so that was stronger than Walmart's, but still both of them have this momentum that seems to continue. And they're getting strength both from the stores and from online. So the strategy that they've sort of been talking about for years and years, how they're going to use the stores and online together, well, Target really did it, and they proved it in the numbers. So they offer these three options for same-day pickup. If you order online and you want to pick up your goods, or get them, I should say, the same day. And so it's pick up, it's drive up, and it's shipped. And those three actually were responsible for 40% of the comp sales growth. So people are really using those services. So they're ordering online and they're picking up at the store and having a Target employee load it into the car, or they're going inside and getting it, or paying that $99 a year for the shipped delivery service. So talk about those actually really working together and proving it in the numbers. And that's what really worked for Target.
Greg, pick apart Target for us.
Well, I think that's a nice summary in the sense that the consumer is giving credit to retailers that give them a true multi-channel experience. And I think this really started last year with Walmart. You saw it yesterday with Home Depot's results, where now 9% of their sales are digital. Target's are now up to 7% of their sales are digital. And the real winners in retail are the ones that are giving that multi-channel experience. And that's what Target's doing. That's why they're driving traffic. They had a nice traffic number, up over 2%. And last year it was up even more in the second quarter. And what they did that might be a little different than some of the other companies, even Walmart last week, is they did it while gross margins actually expanded. So I think that's the reason that Target is up, say, 16% today as opposed to just 5 or 6. It wasn't just the sales and the traffic. It was they actually saw margin expansion while getting those sales. And that's not what many retailers have been able to do.
We heard from so many other retailers so far, Court, that fulfillment costs were on the rise, and that really ate into margins. And yet Target also saw higher fulfillment costs, but was able to offset that with mix and price and promotion.
Yeah, and Greg, you probably know these numbers off the top of your head a little better than I do, but John Mulligan at Target often talks about, because they're using the stores as the fulfillment nodes, they're actually able to significantly lower the cost of fulfillment. I think it was 40% in some cases, and then 90% in other cases, depending on the program that's being used, because the consumer is doing that final trip themselves. They're going to the store.
They become the UPS delivery guy. You just put it in a bag and
So that is really helping. And I think in the beginning, when Brian Cornell talked about the strategy in February of 2017, and he talked about leaning into stores and building more stores, the street was really skeptical. I mean, the stock took a pretty big hit. I think everyone knew that they needed to invest in digital in the supply chain, but they weren't so sure that really pushing into stores was going to be the answer. And today it seems to be, at least.
For Target, certainly.
Greg, we had on yesterday an analyst who talked about Lowe's and was very high on Lowe's, in part because she thought that the same-store sales were going to grow faster than Home Depot's. They did. And she also gives credit to the turnaround that she sees taking place in that company, traceable back to new management.
All right, well, we like Lowe's. We have an outperform on it. We also like Home Depot. We actually prefer it a little bit this year. For us, the big call in home improvement is rates went up last year, existing home sales fell, and there's a long 40-year tradition of home improvement demand getting weak 6 to 9 months after that happens. So the second quarter was actually a pretty tough quarter. The Census Bureau said U.S. home improvement sales were actually negative in the quarter. Both Home Depot and Lowe's showed that they were able to gain share by growing pro-business faster than DIY. So we like both of them, but I think what the key to remember is that both these companies put up a better quarter in a pretty tough macro environment for home improvement.
How vulnerable are those two to tariffs?
One of the things that we like about both of them is that when we do our work, we estimate a 10% headwind to retail earnings next year if List 4 goes into effect at 25%. That's sort of like the worst case scenario. But the impact for them is like 2%. It is companies like Best Buy, like Target, because they have more apparel and toys and electronics, where the theoretical risk is greater than the 10%.